Hello, my name is Marc. Nice to meet you, Mrs. Dalby. I'll be in charge of your...
Mr. Marc.
Right here.
Oh, nice to meet you.
I'm Marc, and I'll be in charge of the team that is going to take care of your income tax this year. So we'll be going over the details with you today to make sure everything's all right.
Thank you. I'm glad I hired such talented workers to help us with our income tax. I don't understand a word of it, but I'm very confident that you'll take us to the complexities of the income tax world.
And I'm sure that this is going to cost us a lot of money. I have heard there's an application online you can download and do your taxes yourself, and it costs $0.
As an accountant, we offer professional insight to understand, to help understand the dynamics and treatment of complex tax issues that most people wouldn't understand. I'll be covering inclusions with you today in the determination of your net income for tax purposes. So according to my calculations, your total income from employment for tax purposes, again, works out to $184,500. $50, excuse me.
But my annual salary is $143,000, and I haven't already had taxes withheld. You're going to tell me that I have to pay more taxes than my salary?
What you're thinking about, Mrs. Dalby, is a net income. Taxable income is computed based on your gross income, which is the culmination of, in your case, income from employment. The $143,000 you're referring to is gross salary. Now, this does not take into account taxable benefits like your car, for instance.
Well, why would they charge her for using the car? The car was given to her by her employer, and she only has it for the past 11 months.
Absolutely, absolutely. Well, as the government sees it, when an employer lends an employee an automobile for use, that car is recognized as a taxable benefit. Now, what happens is for leased vehicles, we use 2/3 of the monthly lease cost, excluding the insurance, and now for the period given, we'll multiply that out. And now what happens is, this brings us to $4,972 for the standby charge, but however, the deal is that since your wife used the car for less than 50% of the year, of her kilometers driven in personal kilometers as opposed to work kilometers, she actually gets a reduction for the standby charge by to 81.8% of what it would be, leaving us with the $4,067 you see on the report right here.
Well, how about this $2,033 here?
That's what's called an operational cost, and it's defined as either the lesser of half of the standby charge or 26 cents per personal kilometers driven. In your case, it's better that we use the half factor, so that leaves us with a total of $6,100 for the total automobile benefit.
That's news to me.
It is to most people. We have to take into consideration all taxable benefits from your work, and this takes into account stock option benefits, for example, bonuses, gifts, and so on. The earned income includes your annual salary of $143,000 plus $23,000 of the $34,500 incentive bonus that you received earlier. You were awarded by your employer.
Oh, well, what about that $300 gift basket from Christmas? Shouldn't that be added as well?
I'm starting to it's fantastic. I'm glad you're starting to understand. But the reason is the amount isn't taxable because it's a non-cash, non-performance related award to an employee, and it's under the limit of $500 a year.
If I remember correctly, you have $34,500 as your bonus. How will you only declare $23,000? You'll get into trouble.
Yeah, that's a good point, but she won't get into trouble. The reason for that is, on a tax basis, you're only going to include that amount from the time it's paid, not necessarily when you were awarded that $34,000. You are going to declare it once you receive. So she's only received $23,000 in this case, and that's what it's going to amount to.
Well, that makes sense. I used to think the government was mean, but now I think that the government is nice.
Well, the government is nice and mean, depends who you ask.
Yeah.
Now, yes.
One more question.
Yeah, sure.
What is this loan benefit business? My employer lent us money without interest so that they could help us to buy our house. So why are we paying taxes on that?
Yeah, absolutely. Now, the way this works is that an employee being lent money by his employer, and especially for no interest, the government again likes to see it like it's a benefit from employment. Now, what that means is that the government is going to set a prescribed rate for loans in this nature, and in this case, for this year, it was 1%. 1% of the $250,000 loan that you got would work out to $2,500 as an inclusion. However, you only got it halfway through the year, so that amount will be half, resulting in $1,250 total.
Ah, okay. One last thing. What is the stock option benefit of $9,600?
Oh, okay, so that actually comes from the benefit of the option that you were given. Now, when we want to calculate how much benefit an employee gets from the stock option, we find the price that they purchased the share at, and we subtract the option price, which is the amount that you paid. Now, the difference between the two works out to $8 per share. You also bought $1,200 worth of shares, 1,200 units of shares, excuse me, and that works out to $9,600 overall. I hope that answers all your questions. Is there anything else? No? Fantastic. So I will send that way over my colleague Heena, and she will answer the rest of your questions regarding the following sections of the dossier. Thank you very much.
Thank you.
Thank you.
Okay. Oh, okay.
Right here. Yes, thank you.
Thank you very much, Marc.
Have a good one, sir.
Okay.
Bye-bye.
Thank you very much, Mark. Hi, Mr. and Mrs. Dalby. I'm Heena.
Oh, hi, Heena. Nice to meet you.
Nice to meet you as well. Not to worry, Mr. and Mrs. Dalby. We will try to make everything as clear and simple as possible. Our job is to provide tax avoidance to you and your family. This is meant to minimize the effect of governmental taxing mechanisms by lowering your taxable revenues, maximizing your deductions, and making certain to claim all credits that you are allowed to declare. As provided per Section 8 of the Income Tax Act, here are some of the deductions you can and should take to reduce your taxable income. The amount you can deduct is $17,600. I came to this conclusion from adding the professional dues, a registered pension plan, as well as the child care expenses. Your total taxable income comes out to $166,450.
Did I have child care support? Because last year I was the one who took the deduction for child care support. Why would she take it this year?
Well, as per Section 63 of the Income Tax Act, which covers childcare expenses, it describes that under certain conditions, like having a spouse that suffers from mental or physical condition, and is unlikely capable of caring for children for an indefinite duration, the spouse with the highest income can claim the deduction. Given your condition, it would be preferable for your wife to claim the deduction.
Oh, that makes sense. That makes sense.
These taxes are killing me. Apart from these recommendations, are there any other ways my family and I can reduce our tax burden?
Great question. So your tax burden can also be reduced using personal or transferable credits. For instance, you can benefit from the Canada Employment Tax Credit for the simple reason that you are working. Just to mention a few, there is also the Basic Personal Tax Credit. Also, since Mr. Dalby isn't paying any taxes, he can transfer some of his tax credits to you. Mark can also transfer his tuition and textbook credit to you. Furthermore, due to Mary's condition, you are eligible to get the infirm dependent over 17 tax credit, the eligible dependent tax credit, the caregiver tax credit, as well as the disability tax credit. My colleague Will shall make other recommendations on how to lower your tax burden. Thank you very much.
Thank you very much.
Thank you very much.
Thank you very much, Heena. Good afternoon, Mrs. Dalby.
Good afternoon.
Hi. Mr. Dalby, I'm
William.
over here. How are you?
Nice
to meet you, sir.
Nice to
My
meet you.
pleasure, my
Yeah.
pleasure.
I was just wondering if you can lower our tax burden, without getting us into trouble. I learned a lot of people do something called
Mhm.
tax evasion,
Yes.
and to reduce their tax burden, they go to prison. A blind man can survive in prison.
No, that truly is a difficult situation, and yes, you will get in trouble if you try to evade tax. Now, if I may, I should make a clear distinction as to the difference between tax evasion and tax avoidance, which is what we are here to do, help you avoid taxes. Now, tax avoidance is a service we provide in order to reduce your tax liability and your exposure to taxes within the spirit and confines of the law. Tax evasion is the direct opposite. In contrast, it's an illegal act where you generally misrepresent information submitted for your taxes in order not to pay taxes. So, now, I'm looking here, now, at your file, and now, to minimize your tax liabilities, for now and in the future, I see that your tax liability is $35,805.53. I would recommend opening a registered retirement savings plan, since it would be beneficial for you to start contributing to it now. This will give you some form of a deduction.
We are be contributing to one called registered pension plan. What's the difference?
You mean you're talking about an RPP? Well, I'll tell you, an RRSP is a self-directed and administered plan, a plan that's administered by a financial institution that will provide you, or will use either a money purchase or give you a defined benefit at the end of the time when you're ready to retire and take the money. Now, a registered pension plan is normally administered by your employer. As you very well know, it's deducted at source each time you get paid, and it's contributed to your fund, which ultimately will accumulate till when you retire at 65. Furthermore, I was thinking I would recommend you opening a tax-free savings account for the children who are 18 years of age and above. Marc, for instance, if I'm not mistaken, has room to contribute around $32,000. And this includes 2017. Mary can contribute up to $21,000, and also has, if I'm not mistaken, she'll be eligible for a registered disability savings plan, which, even though the contributions are non-deductible, the earnings are tax-free.
Well, I almost spent $15,000 on meals and entertainment at the request of my employer and was only reimbursed $9,500. Why can't I deduct the balance?
Why you can't deduct the balance?
$5,300.
Ooh, okay, let me see now. You know why? Because technically you're ineligible for this deduction, because if I'm not mistaken from what you told me about what you do for work, the Act specifies and is very specific in and how people are able to deduct meals and entertainment. Now, Section 81F is for salespeople. You're not a salesperson, so that's out the window. Travel expense. Did you have to travel to meet these clients? You're ineligible for that. And if you're an employee, you're not self-employed, so there again, you can't get the deductions, or you cannot deduct the meals and entertainment. The only thing I could suggest to you is if you have your employer fill out a form which is called a T-2200. This form is a form that tells Revenue Canada that you are obligated to pay for all your own expenses. Your employer will fill that out, you sign off on it, and that will give you an opportunity, if you're eligible, to deduct the expenses incurred for taking out your clients to lunch. That's my recommendation to you.
Oh, thank you very much. Thank you very much. Your recommendations will be helpful. I'm sure we're going to save ourselves a lot of money next year.
Yes, it's my pleasure to help you, and that you will save a lot of money, except the amount you have to pay me.
How's your hand again?
It's right over here.
Oh, okay. Thank you very much.
My pleasure.